Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Going to take a quick look at Alphabet Inc., ticker GOOGL or GOOG, depending on the class of shares you own. This is a stock I do own quite a bit of. It's probably my third or fourth largest position, depending on the day. Down about 9.5% after earnings, but one has to remember it's still up over 40% year to date. This is a stock that was trading in the high 80s, low 90s just couple months ago, and I was buying at the time. Wanted to revisit to see if it's worth buying again, or at least set a price target to continue accumulating because this is a company that I like quite a bit. If you look 3 years out, 5 years out, 10 years out, 20% annual returns, not unheard of for a company like this, although growth is slowing, and I think that's one of the reasons the stock is punished a little bit because of their earnings. Let's look at those earnings, up 11%, which is constant to the last quarter if you look at constant currency, operating margins in that 28% range, ton of free cash flow. This is a company that has an immaculate balance sheet. We're talking about $100 billion in excess cash over debt. They could do something with that money, and I think they will. If you think about Disney and their talk about potentially spinning off ESPN, selling ESPN, partnering with somebody on ESPN, and Google's recent foray into sports with NFL Sunday Ticket, YouTube TV, whatever you want to call uh, their business there. I think they're a potential partner if they really want to focus on sports because ESPN would allow them to do that. They have the capital to keep buying up sports rights and really consolidate as a major sports player in the entertainment space. So what's going on in the earnings? Well, Google Cloud kind of sucked in a way. I mean, they're still up 22%, but when you think about Azure growing at 29% off of a higher base, when you think about the fact that Google is the third player in a somewhat fragmented space, but really an oligopoly between Amazon, Microsoft, and Google. That growth is a bit disappointing. It's a deacceleration of growth when the market was looking for continued strong growth in the high 20s range. And again, this is a business that they're investing in right now, so you would expect more growth. I think the growth is explainable though. If you think about AWS, which is about a third of the market share, Azure, which has about 22% of the market share, those guys are more focused on the larger end of the corporation side. When you talk about the Fortune 500, if you look at the top 100 companies, you're going to see a good portion of them either with Amazon or with Microsoft. But when you look at the smaller end of that Fortune 500 space, or even the largest 1,000 companies in the world, Google's got about a half of those, but a lot of them are smaller businesses, smaller companies. And that can be a good thing for growth potential, but it's not a great thing when there's a bit of turmoil in the economy. Cost of capital is higher because those smaller companies are going to be more likely to cut back costs, to really look at their bottom line, and that's going to impact Google's ability to grow when they're focused on that smaller end of the scale. On top of that, sometimes when you think about cloud, it can be difficult for the third player in the space to break into the larger companies simply because so much talent is already knowledgeable with AWS, so much talent is already knowledgeable with Microsoft Azure, less talent is knowledgeable on Google Cloud because those big companies don't use those products right now. And it's kind of hard to move off of AWS. It can be hard to move off of Azure into something new. So it's difficult for some of these smaller players, and Google Cloud is still a smaller player. Some of the other players in the space are like 4 to 3% market share to take away from AWS or Azure. So when you look at Azure growing at 29%, Microsoft Intelligent Cloud itself, which includes Azure, growing at 19% off of a $20 billion starting point, 22% growth off of a $6.8 billion starting point isn't that impressive, and that's what the market is reacting to. On top of that, Google Cloud is still very much in the investment space. You can kind of see that it's starting to break even, 3.5% margins on 8.4 billion in revenue. Compare that to AWS, compare that to Intelligent Cloud, where those margins are in that 25% plus range off of a much larger revenue base. So those companies are making a lot more money off of cloud than Google is, and they're able to reinvest that money into their cloud product, into other products, whereas Google is the reverse. They're making a ton of money off of search and off of advertising, and they're not really making a ton of money off of cloud, but they can use that search money to invest in cloud, and that's really what they're doing. They're investing in cloud, they're investing in other bets because those two aren't really making money right now. However, when you look at Google as a company, why do I own Google? Well, it's because Google search is probably the best business in the world. It's either that or Apple, the iPhone. I also own Apple. I also own Microsoft. I also own Amazon, FYI. I just think they make so much money. It's a 50% operating margin business. It's growing still at a 10 to 11% clip. Google Network showing some weakness. Google Network is basically, if you go to a website and Google ads are served to you, that's Google Network. YouTube ads is self-explanatory. YouTube.com advertising, they are starting to cut back on people using ad blockers there, so maybe a bit more money to be made there. And then Google search, which is just google.com, Gmail, Google Play Store advertising, etc. And then you've got this Google Other business, which I think is starting to get interesting, growing at about 21%, and that's their hardware, whether it's Pixel phones or Fitbit. It's also YouTube TV, YouTube Premium, all of those services. There's also NFL Sunday Ticket. And I think this is where there's opportunity for growth alongside of cloud. They have so much money on their balance sheet. What are they going to do with it? They've already shown some interest in sports rights with the purchase of NFL Sunday Ticket. Are they going to do more of that? I think YouTube TV is probably the preeminent player. It's hard to tell. It's right up there with Hulu TV, Hulu Live, whatever they call it, but certainly some interest on Google's side in the TV space and the entertainment space. Like I said, are they a player for ESPN if Disney decides to part with that? I think they could be. I think it's an interesting proposition for them. Another growth area that they could focus on, that entertainment space. I think they have so much money, they generate so much free cash flow. They could be a big bidder in the sports rights space, kind of follow what some of these other tech companies are doing, whether it's Amazon, whether it's Apple. Could they get the Formula One rights in the future after they're done with ESPN? Or could they just simply partner with Disney on ESPN or an ESPN live service that could be hosted on Google's cloud? Who knows? Maybe that's their future. That's kind of what I'm hoping they do as a shareholder, but who knows? I think these earnings weren't as bad as they seem. I do think cloud is showing some weakness, which is a bit of a concern. Is this going to be a two-horse race down the line, or can Google Cloud really make some headway in there? I've heard some talk about Google AI actually being better than some of the other players in the space, whether it's Google AI on their cloud hosting rather being better than some of the other players in the space. But then you hear the reverse half the time too, so it's hard to tell. I mean, I'm not super well versed in the cloud space. I'm just well versed enough to kind of talk a little bit about it. But at the end of the day, that's not what interests me about the stock. It's really the other parts of the business, the Google Cloud and the other bets side of the things are just a cherry on top, because right now they're not really making money off of it, but they will in the future, right? Google advertising, I think, has no mirror, right? Google Chrome is probably the best browser. Google.com is the best search engine. Nobody can compete. Even if they have to give up their $8 billion payment or however much they make to Apple to be the default search engine on the iPhone, which is, I think, an important thing. I think most people will still choose Google.com to be the default engine, and they can save the billions of dollars they pay Apple. So maybe it's not a bad thing. Who knows? Certainly some, will the FTC allow acquisitions like, Google acquiring anything because they seem to hate tech companies acquiring anything these days, although they allowed Microsoft to acquire Activision Blizzard, so Google could probably acquire ESPN because neither competing with anybody at this point. So why not use some of that money that they have on their balance sheet to acquire something and help supercharge growth in some of the areas outside of advertising, because they already have advertising on lockdown. As far as the valuation goes, this is a stock that's currently valued in the sub 4% free cash flow yield, which to me maybe is a bit aggressive, but not ridiculous either, given what this company is and how much free cash flow it generates and what it's able to do for investors in terms of buybacks and in terms of their balance sheet, etc. They're starting to slow down growth. I'm assuming about 8% growth for the next couple of years. The estimates here are kind of escalating growth into 24 and 25 before slowing down. So I'm a bit more conservative, ending at 415 billion in 27 versus 453 on the estimate side. As far as my margins go, I'm a bit more conservative as well, going into 23 and 24 and 25 and 26 and 27, ending up at about 117 billion in free cash flow on the estimate side versus about 105 billion for me. I just think the margin increase here is a bit aggressive. I do know that they're cutting back on the real estate footprint. There were certainly some layoffs this year that are going to impact margins. If you look at their free cash flow for the last 12 months, it's 79 billion versus 69 billion that I'm projecting here. You might ask, why is that the case? Well, they have about a $10 billion tax deferral that they're going to pay, or they already paid actually, that is going to show up in Q4 23, Q4 23. And then I'm assuming some margin improvement into 24 onwards, simply because, hey, they're cutting back on expenses, so their revenue is going to grow faster than their expense base this year and next year. They already mentioned that on some of their calls. I'm still going to assume that about 35% of their money is going to go back towards buybacks. They've bought back about 35 billion in the last 2 years per year of stock, in excess of the stock-based compensation. So that's about 50 billion plus in buybacks versus 20 billion in stock-based compensation. So that's about 150 billion in stock buybacks. They're still going to have about 300 billion in excess free cash flow in the next 5 years. That's how good this business is. In addition to the 100 billion they already have on their books, what are they going to do with that? I think acquisitions are going to be had. This is going to be an interesting time because some of these smaller tech companies are, being reevaluated based on their cost of capital going up quite a bit, based on it being tougher for them to raise money right now, whether it's through issuing more shares or borrowing money. So Google might have some good deals ahead of it, and that's going to be a good thing for the long term for a stock like this. I'm assuming about 4 to 5% free cash flow yield, weighing closer to the 4% yield versus the 5% yield, but you can kind of make your own assumptions. I'll share this spreadsheet. Just hit file, make a copy in the description down below. Disclaimer, as always, this video is purely for informational, educational, entertainment purposes only. It is not investment advice. Do your own due diligence, all of that good stuff. And as always, if you enjoyed this video, if you like what I'm talking about here, if you like these types of spreadsheet, like the video, subscribe. There'll certainly be more of this. At today's price point, at 125, I think the stock is down pre-market a little bit. I'm expecting about a 10% return from here, which is pretty good, I think. Would I be a buyer here if I didn't already own a bunch of this stock? Maybe, although in general, when I see a market like this where you can get 5 to 5.5% yields on just cash, I'm generally pretty patient and I wait for deals to be really good. So that's why I've been targeting closer to 15% returns on some of these stocks. I haven't really been buying much lately. Honestly, I haven't bought really anything. I've just been hoarding cash, waiting for good deals to arise, and I have a bunch of cash to do so. If I'm looking for a 15% return here, that's about a fair value of about $102, which is still 18% off of today's price. Maybe that's a bit too conservative for a company like Google, for a company of their caliber. You go to 12.5%, it's about 114 bucks. Again, if you go to 10%, the fair value has already been reached because you're getting about 10.3%. If you want to be more conservative on the free cash flow yield, at a 5% free cash flow yield, the fair value at about a 12.5% return is about 100 bucks. So things to keep in mind. I think for me, I'm going to really start looking at this closely somewhere in that 102 to 114 range. That's really where I'd get interested. And the only reason for that is I think today's price point is very intriguing already because I think this is a fantastic company, but I already own a bunch of this. So if I want to really overweight this position over what it is today and potentially make this my number one holding, I'd really need to have a good price point, a good entry price point here. And that would be somewhere in that, $102 to $114 range. It's not really where it is now. I'm very comfortable just holding my current position, which, like I said, is a top 3, top 4 holding. But until it reaches that 102 to 115 range, I think I'll set a fair value alert for myself in that $114 range and probably start accumulating there. And if it keeps falling, accumulate more. So just slowly start accumulating at 114. And if it keeps falling below that, accumulate a bunch more until the low 100s. And again, it's not a crazy thing to think that this stock could be in the low 100s anytime soon. 5 months ago, 6 months ago, this was at 90 bucks, right? So what's changed? Yeah, their earnings were pretty solid. but there's some question marks around growth in the Google Cloud. If that's deaccelerating, if that's not really going to be a strong business for them going forward, it's really going to be up to advertising to carry the weight, and obviously any acquisitions that they make. I do think some acquisitions are going to be done in the next 1 or 2 years. Would not be surprised by that. Will the FTC hold those up? Who knows? They haven't really made any huge acquisitions in the past. They've made some small ones. And if you think about this fair valuation, you're not really valuing any of these other bets, whatever they may be, whether it's Waymo or something else, DeepMind, whatever, at anything, right? So that's another thing that you may get. But those other bets aren't really giving you any revenue at the moment. They're growing at 50%. So wow, super growth, but they're still losing $1 billion plus every quarter. So something to keep in mind. I do think this is a fantastic stock. Wouldn't be upset at anybody for buying at today's prices. But for me, since I already own so much of it, I'll just wait to see if it can go lower, as I always do. Maybe I'm a bit too conservative, who knows? Let me know what you guys think about Google, if you are a buyer at today's prices or if you're waiting for it to go a bit lower. For me, I think I'll wait for it to go a bit lower. Leave a comment down below, like the video, subscribe. Thanks for watching. Bye.